All right, let's talk about one of Canada's banking giants, the Canadian Imperial Bank of Commerce, or as pretty much everyone calls it, CIBC. For investors, CIBC has always been this fascinating puzzle. So today, we're going to put all the pieces together and see if we can get the full picture. And that puzzle really starts with this one big question. CIBC is a cornerstone of the Canadian economy, no doubt. Yet its stock always seems to be trading at a discount compared to its bigger rivals. So why? What is it that the market sees that makes it just a little more cautious? Let's dig in. Okay, first things first, we need to understand exactly where CIBC fits into the whole Canadian banking scene. Canada's system is basically an oligopoly, right? It's dominated by just a handful of massive banks. But even inside that exclusive club, there's a definite pecking order. And this table just lays it all out perfectly. If you look at the numbers from 2023, you've got your clear leaders, Royal Bank and TD way up at the top. And then you've got CIBC sitting there firmly in the number 5 spot. I mean, it's a huge company, don't get me wrong, but in this league, it's definitely a follower, not a leader. This number right here really puts the scale of that challenge into perspective. At just over $59 billion, CIBC's market cap is less than a third of Royal Bank's. And that size difference isn't just about bragging rights. It affects everything, from economies of scale to how much they can spend on marketing. It really forces CIBC to be smarter and way more focused with its strategy. So what is it that's holding back its valuation? Well, the biggest factor is this heavy anchor that's tied to its balance sheet. And that is its deep and some would say risky concentration in the Canadian housing market. Just take a look at this breakdown of CIBC's loan book. Over half, 51%, is tied up in Canadian residential mortgages. This makes the bank's health incredibly sensitive to the average Canadian consumer and whatever's happening in the domestic housing market. When times are good, it's an amazing business to be in. But when the economy starts to get a little shaky, that concentration becomes a major source of anxiety for investors. And look, this isn't just market gossip. The Bank of Canada itself has been waving red flags about household debt and housing prices for a while now, calling them key systemic risks. So what that means is that CIBC's core business is directly exposed to what many people think is Canada's single biggest economic vulnerability. Now, to understand how this risk actually shows up on the books, you need to know this term, provision for credit losses, or PCL. The easiest way to think about it is it's the money a bank has to set aside in a rainy day fund for loans that might go bad. And when that PCL number goes up, it's a direct hit to the bank's profits. And lately, well, it's been getting a little rainy. The bank's loan loss ratio more than doubled from 2022 to 2023 as those higher interest rates really started to bite. Now, you can see that the provisions have eased up a bit through 2024, but they are still way higher than they used to be. This is that mortgage anchor in action, and it's weighing directly on the bottom line. But that is only half the story, because while that anchor is weighing the bank down, management is firing up a really powerful engine to try and push it forward. And that engine is a huge strategic bet on growth south of the border, in the United States. And this isn't just some random idea. It's part of a very clear game plan. Management has laid out these 4 key priorities, and look at number 1, a direct effort to diversify by growing its wealth management business across all of North America. The goal here is pretty clear. Build a more balanced bank that's less dependent on the Canadian housing market. This whole American strategy isn't brand new. It was actually built on a major move they made way back in 2017 when they bought the private Bancacorp out of Chicago. That deal gave CIBC the foundation it needed to really build out its U.S. commercial banking and wealth management platform. The big question for investors now is, can it actually deliver? And you know what? The early signs are looking pretty promising. After a pretty tough 2023, the U.S. business is showing some serious operating leverage. Net income rebounded sharply in the second and third quarters of 2024. This suggests that as the economy finds its footing, that U.S. engine can really start to roar. And it's not just happening in one little corner of the business. The strategy is delivering real, tangible results right across the board. They're number 1 in Canadian mutual fund sales, which is great for high-margin fee income. Their total assets under administration are surging, and their U.S. capital markets revenue is growing strong. This is some of the clearest evidence you can get of solid execution. So, we've got the risk, and we've got the growth strategy. But how is the bank actually holding up right now, today? Let's check the vital signs. And the first, and maybe the most important, vital sign for any bank is its capital buffer. For CIBC, that's a Common Equity Tier 1 ratio of 13.3%. So what on earth is that? Well, that number is basically the ultimate measure of a bank's financial strength. The CET1 ratio is the safety cushion it has to absorb unexpected losses. A ratio this high, I mean, it's well above what regulators require, means CIBC has what you'd call a fortress balance sheet. For any investor, that's a huge pillar of stability. And you can see that financial strength translating into steady performance. In the second quarter of 2024, CIBC delivered some modest but positive earnings growth. Yeah, it might not look spectacular, but compare it to Scotiabank and BMO, which both actually saw declines. In a tough environment like this one, CIBC is proving to be pretty darn resilient. But the vital signs aren't perfect. The bank's return on equity, which is a key measure of profitability, is sitting at 14%. Now that's solid, but it's still below management's own target of over 16%. It tells us that even with a stable foundation, this challenging environment is still putting pressure on the bank's ability to generate those top-tier profits. So, when you put all of these different pieces together, the market position, the anchor, and the engine, you arrive at the core investment dilemma that is facing CIBC. And here is that dilemma, in a nutshell. On one side, you have all the reasons for the stock's discount, that heavy reliance on Canadian housing, its smaller scale, and the risk that the U.S. strategy doesn't pan out. But on the other side, you've got some really powerful catalysts, that rock-solid capital base, clear momentum in wealth management, and growing success from that U.S. expansion. And you can see how the market prices this dilemma in real time. CIBC trades at a price-to-book ratio of 1.68, while the market leader, Royal Bank, gets a multiple of 2.18. That gap right there, that's the price the market is putting on CIBC's risks, but it also represents the potential upside if its strategy really pays off. Which brings us to the final question, the one that really matters. This is the entire investment thesis all boiled down into a single thought. You've got the heavy weight of the Canadian mortgage anchor versus the growing power of the American growth engine. So an investor in CIBC today is really making a bet that, in the long run, the engine will prove stronger than the anchor. And monitoring that dynamic, that's the key to understanding this bank's future.